This is Brandon Wolfe. I'm submitting this presentation for completion of financial analysis, DSA 5303. My project is on finding new flash crashes. I'm going to be searching through tick data from the New York Stock Exchange in order to find novel flash crashes that nobody has found before, and using those data to eventually train an algorithm to predict flash crashes. I'm supposed to be improving and extending the results of a paper. The paper in question is Galoob et al. 2012. In that paper, they define what a flash crash is. Searched through data between 2008 and 2010. They had 3 months of access, I believe, to tick data. And then they did some analysis on that. I'll talk about some deficiencies in their definition and therefore their analysis. And then later on, an electronic analysis firm called Pragma performed much the same research, in this case, in Forex markets. So I'm going to be expanding on this work by proposing a new definition for flash crashes, which would improve on both of these definitions. So the reason why this is important, if you have a look at how high-frequency trading has taken over the volume of trading on the market. On the left-hand side, you can see the comparison between, this would be dealer-to-dealer by voice trades, in other words, very traditional fundamental type trades, Warren Buffett type trades. The electronic platform, which is what you would expect, people using their computers to execute trades in an optimal fashion. And then since 2006, there's been a huge rise in algorithmic trading or high-frequency trading, which is a different type of beast than the computer just executing the trade. That would be this pink bar here. As you can see, algorithmic trading or high-frequency trading actually peaked around 2009. That was when there was a large amount of volatility, and the checks on high-frequency trading, which exist now, weren't in place at the time. So high-frequency trading in some way cheats the system. It looks for tiny advantages that you can get by looking at the order book or by executing your trades faster than everybody else. In other words, you're looking to game the system. It doesn't look at market fundamentals at all. High-frequency trading is just looking at its microsecond neighborhood in order to find behavior just in the ups and downs, the periodic changes, the wiggliness, the random noise that's in trading data. High-frequency trading attempts to take advantage of that. One of the reasons why it's tailed off in recent years is that volatility has trailed off, and high-frequency trading actually, it loves volatility. It lives on volatility. To make money via high-frequency trading, you don't necessarily care if the market as a whole is going up or down. You want the volatility. It's just taking advantage of the random nature of the data that's coming in from the market. As you can see, this is the JP Morgan's head quants concluding that because the passive and quantitative investors account for so much of the equity asset trading. So you can see here, it's not just the high-frequency trading that's gone up, it's the passive funds. In other words, these are things like ETFs. People don't want to trade actively in a particular stock. They either want to put all of their money into an index fund or they want to use high-frequency trading here. And you can see here that between high-frequency trading and ETFs, it's now accounting for the lion's share of trading that's going on in the market. In other words, the market is being driven by these things as much or more as it's being driven by market fundamentals, especially when you're asking what causes something like a flash crash. So passive and quantitative investors now account for 60% of equity assets versus only 30% a decade ago. This means that while fundamental narratives explaining the price action abounds, the majority of equity investors today don't buy or sell stocks based on stock-specific fundamentals. There's a real challenge here from high-frequency trading. The mechanisms that it uses to make decisions are very, very different than the mechanisms that we're used to. So what that means is at the end of every stock day, the newsman comes on and tells us the stock went up 500 points today on good inflation data, or everybody's worried about the recent jobs report. What this means is that the reason for at least immediate flash crash type stock moves doesn't have anything to do with those just so stories. It has to do with a completely different time scale of data, and it comes from a completely different direction. It doesn't fit what we humans, what the macro scale explanations that we try to come up with. It really has changed our relationship with the market. So, for example, here are 6 explanations that popped up immediately after the 2010 flash crash. Everybody seeks to make explanations that make sense to them on a human scale, but in order to figure out what happened in that flash crash, you had to look at the microsecond data. You had to really get into what was happening on the time scale that was relevant to the flash crash. So that's what we're going to be doing in this study. Before I talk further about high-frequency trading, it's a good idea to classify what high-frequency trades are and to give some examples of high-frequency trading algorithms. So I break up algorithms into 3 sections. A weak algorithm is when the computer is just doing what the broker tells the computer to do. So the broker tells what the trade is, and the computer just executes it in an optimal way. So this is not really a challenge to the way people are thinking of the market. Moderate algorithms are what quants have used, what's taken over maybe in the last 10 years or so. This is maybe linear regression, a narrow task or strategy for the algorithm, and then the algorithm executes trades according to the strategy. So a quant sits behind the computer, creates a linear model based on some training data set, and then the bot only knows the results of that model and goes out and looks for pricing signals. Strong algorithms are coming up now, and just like strong AI, a strong algorithm looks at data without a hypothesis and decides what it thinks the patterns are, and then potentially executes those trades autonomously. So the only ETF that I know of that's based on a strong algorithm right now makes a big deal that human beings are the people that are executing the trades. The AI is only looking for patterns, but it's certainly possible for everything to be automated in this way. If I wanted to classify some of the high-frequency trading algorithms, the one that this study falls into is the strategy implementation algorithm. So that's when you use historical data, historical tick data in our case, in order to make a linear regression model. In the future, I'll be looking to make what's called a multiple instance linear regression model. I'll talk about that in just a second. But you can also do things like statistical arbitrage. So if there's, or which one was that? Electronic. Yeah, so looking at the bid-ask spread, so if there's a widening gap in the bid-ask spread, then you can use that as an opportunity for arbitrage. And this kind of electronic market making is one of the things that leads to the flash crashes, as we'll see in a little while. So one, like what's called a fat finger trade, will step in and make a poor trade, something with a very large bid-ask spread. And then these kinds of algorithms will step into that widening bid-ask spread, and that creates the snowball effect that leads to a flash crash. Statistical arbitrage looks for correlations between different types of events. That's another thing that we'll be looking for. We'll be seeking to correlate flash crashes to different types of events. And then finally, deep learning is the strong type of algorithm that's just now starting to find spots. Here are some historical flash crashes. I went all the way back. The first time that I could find flash crash being referred to in any media was back in the Kennedy administration. So I want to distinguish what I mean by a flash crash from this type of a flash crash, what's been called a flash crash, which is really just a normal market move. So in the 60s, there was the Cuban Missile Crisis. There was an overall decrease in consumer sentiment, and that led rationally to a drop in the stock exchange. A flash crash doesn't refer to the speed of a decrease. So yes, it dropped more slowly, but even if this had dropped more quickly, if it was still based on market fundamentals, that's not a flash crash. Each of these other examples, it doesn't just fall or rise, a flash up crash. It does that and then immediately rebounds to its original price, meaning that the fundamental price wasn't in the flash crash. So the flash crash did not reflect where market fundamentals were. It bounced immediately back to that fundamental price, and that means that those kinds of flash crashes from May up until 2018 were really artifacts of the high frequency trading world. So it's really the rebounds that make something a flash crash. And that's going to go into our definition when we start to get to that. In my research, I found several predictive indicators of flash crashes that you would want to use in building a model, in addition to just the price or the volume or the bid-ask spread. What's called a VPIN was initially proposed after the flash crash in 2010. It's a new wrinkle on the VIX, a volatility index. It's since been challenged as a quality indicator for flash crashes, but these researchers certainly claimed that it foreshadowed the actual crash. There's been research afterwards that continues to indicate that. We can just toss the VPIN into the model, and if it improves the model, then you could determine whether or not it was a good predictor. And that goes for any possible predictor, whatever people are claiming is a good flash crash. If you have a data set and you build a model for predicting the flash crash, then you can determine any predictor, whatever you think it's supposed to be, you can determine whether that's a good predictor based on whether it improves the model. Aldridge in 2014 proposed that the length of a run was also a predictor of flash crashes. She said that if there's a large number of trades that on a particular direction in the bid-ask spread, that decays the liquidity on the other direction, and that is predictive of a flash crash. Once again, you could put the runs in as an indicator on your model. In correlations, this is more of like a conventional wisdom, conventional market wisdom. Obviously, when there is a crash, everything is going to increase in correlation because it's all going the same direction, it's all crashing. But that's not necessarily, need not be the case if you're looking at intersectional correlations. So this is the cross correlation between utilities and financials, and they go from, this is on the market shock on February the 5th. So preceding the market shock, there was a sign change in the correlations. These things were negative correlations. Utility and financials were negatively correlated. They suddenly became positively correlated just prior to the crash in February of this year. So one of the possible correlations, one of the possible indicators of a flash crash would be the not just correlation of the entire market, but the correlation between different sectors. And this could also be the correlation between an ETF like VIX, like the volatility index, and the overall market like SPY. Also, if you were interested in studying flash crashes of the market of the whole, then you would need to get tick data for that ETF, for the market as a whole. Okay, so I'm going to talk now about the R code and how I acquired the data and how I analyzed it. Acquiring high quality, high frequency data is actually a problem of its own. A lot of the trading firms don't make as much money from their trades anymore, and so they make their money from data. It's really expensive to get historical data sets. And the individual places, Chicago is very possessive of its data. They don't just make that stuff publicly available. The only website that I could find that had publicly available high-frequency data was a Norwegian website called Netfonds. So in my R code here, I've defined a calendar. You can only acquire the last 5 business days, so this defines the business days and the previous 5 business days, and then determines the URL. The problem with this Netfonds website is that it only has New York Stock Exchange symbols available. It doesn't have all the symbols. So the first thing that I did was download the symbols that it had available and store those to go through in a for loop. And then this is just sort of an outline of what the code looked like. There was a lot of cleaning up in between here. So I create two linked lists, one for the data over 5 days and one for all of the stocks available. Loop over the days and the stocks. Put a URL in using the vectors that are previously defined. Download that into a data frame. There's a couple of things that I need. I need if the trades are going up and down between trades, are they increasing or decreasing? Then a Boolean version of that up-down data. This little function determines how the length of the run, in other words, how many positives or how many negatives in a row, and then add that to the growing list. And then at the end, I can concatenate the lists if I want to. This is the condition that defines what a flash crash is, and I'll talk about this is the Galoob conditions, and I'll talk in a second about what types of conditions would be the best. That's really the main result of the research. So there's deficiencies in the definitions of flash crashes that the researchers have used in what I've looked at. Nanex from the flash crash, the original flash crash, and then Galoob in a study after that gave these definitions for flash crashes. And you can see that's reflected here in my definition. So which ones have a run length that's greater than 10? It has to change by at least 0.8%, and the time has to be less than 1 second. I looked at everything less than 10 seconds just to see if I was missing anything here in the code. So there's a problem with this, which is there's a couple of problems. This is an example of a flash crash. So I ran this on all of the stock tickers in the stock exchange for the last 5 days, and I came up with 17 potential flash crashes. The lion's share of them had to do with just morning volatility. You can see here that they've identified this jump here as a flash crash. Well, the market doesn't stop in the evenings, and there's a what's called a smile in liquidity. So the very early morning and the very late evening, everybody tries to get their money in. And this is just the asset finding equilibrium with what its new value is that was determined overnight. So this is not a flash crash. This is just coming back to equilibrium with reality, and that can't be counted in your counting of flash crashes. This was marked as a positive flash crash. It's this one over here, and yes, this was a run, and it was a large enough run to be considered. But obviously, this number here, the 0.8%, was too little. This needed to jump way more than what it did in order to be considered a flash crash. And also, it was just really part of the normal volatility for this particular asset. So that needs to be taken into account as well. The grand total of these things is that 14 of the 17 identified flash crashes weren't really flash crashes. I disqualified them, which means that in that research, they identified something like 5,000 flash crashes and then drew conclusions from that. There would only be, say, 400 in the 3 months that they analyzed. That were real flash crashes, and the conclusions that they drew I can't even imagine if it's a factor of 10 or worse, that they're looking at the conclusions they drew really, I don't see what validity can be given to them. So the definition of what a flash crash was is really important to what kinds of conclusions you're going to be drawing, because this is not a flash crash. Pragma came up with a different set of conditions for flash crashes. They fixed this problem that this jump is within the bounds of normal volatility, so that's better. They assumed a widening bid-offer spread, and I'm going to show in a second that this is an invalid assumption. They did put in that there was a strong price reversion. This is really a necessary condition for something to be a flash crash. That's what the revision, the price bounce, is what makes the flash crash belong to the domain of high frequency trading and not market fundamentals. So this is better. But as you can see, so this is a real flash crash. This is what they're talking about. So a big flash crash like this corresponds to a big difference in the bid-ask spread, and that's the reason why they use that as a condition. But it's not a necessary condition. This is a flash crash that I found in ADT on April the 19th. So the first thing is that that's surprising is that these things are happening all the time, and if you just look carefully, then you will see flash crashes all the time. The reason why they're not important to people, the reason why this list of historical flash crashes is so short, is because these are the ones that were the most important to people, the ones that people were paying attention to on a microsecond level. If they were paying attention to individual stocks on a microsecond level, they would see flash crashes daily, constantly. The flash crash is not an aberration, a technical difficulty with the market. It's characterized by the market. It's something that happens all the time, and it is not attached to news items. It's not attached to market fundamentals. So there's something else that's going on with them. So this guy is a flash crash, and it did not have a widening bid-ask spread. So there was no problem with the bid-ask spread. There were people that they all of a sudden thought that it was worth far less, and everybody agreed with it, and it led to a flash crash. So this was not the standard model for why flash crashes occur. Here's two classic flash crashes. So the first one is in ACH stock. That's a Chinese aluminum company. This was really quite an extreme flash crash that probably had to do with what's called a fat finger trade. So you can see here at 56,796 seconds, this guy makes a ridiculous trade. And because there's a widening in the bid-ask spread, there's a number of trades afterwards that come along and attempt to take advantage of that. So what's interesting about this is that the volume on this trade is tiny. We're talking about 100 shares here. And yet the total volume of the flash crash is not tiny. So there's a number of trades that come along behind that, and in some cases very large trades that come along behind that seek to take advantage of the bid-ask spread, and they turn the glitch, they turn the imagined trades, this one bad trade, into a reality for a very short period of time. And then the third actual flash crash that I found was actually an up crash. This was in SMG stock 5 days ago. And so you can see here, one of the things that happens after a flash crash is that there's a great deal of volatility. There's a problem with liquidity in the book orders immediately following a flash crash, and that can extend for several minutes after the flash crash. So even though this flash crash was over in a second, there was troubles in the bid-ask spread that occurred after that. Incidentally, that's an opportunity for arbitrage if you were to identify something like that. So in my study, I've suggested a new flash crash definition. So the Galoob flash crash definition is lousy because it includes morning volatility, and it includes moves like this that aren't necessarily flash crashes. The Pragma definition is better, but it assumes that there's a connection to the bid-ask spread. The bid-ask spread is predictive, but it is not necessary. So this is my definition, and I would suggest that this or something like it takes hold on markets in general. If not this definition, then some definition is necessary for everybody to agree if a flash crash has occurred or not. So I went with the Galoob condition. Instead of looking at the volatility, a multiple of the volatility, it seems sufficient to just look at 1.5% of the total value. This is a larger number, however, than Galoob originally assumes. I also assumed that it is fast, within 1.5 seconds. That's something that Pragma left out. It allows for morning volatility. I don't look in the first 30, maybe 45 minutes of trading. There's a strong price reversion. 70% of the original price is regained, but I've put in an additional time boundary on that. And these are two just points. The length of runs that was from Galoob is not necessary. It's only predictive. In other words, you would put the number of runs into as an indicator, but it will not define a flash crash. And the same thing goes for the bid-ask spread. That's a predictor indicator variable. It is not a condition to define a flash crash. Okay, so in conclusion, there was several studies, and I'm curious, in addition to building a model to determine what a good predictor indicator is for flash crashes, it's possible that flash crashes are themselves predictive of larger problems. You can see that here in ADT. So the flash crash occurred right here. It was completely smoothed out. In other words, normal market traders don't see these events because they're smoothed out in the 1-minute averages or even the 5-second averages that are reported to traders. So traders don't see them at all. So the ADT stock had a flash crash which brought it down to about this level in a microsecond. And then the next day, that correlated to a decrease in the equity. That seems to make sense that there would be that correlation. I wasn't able to find enough flash crashes. Not having a full high-frequency data set, wasn't able to find enough to really confirm that correlative relationship. But other researchers have also attempted to find such a correlation. Levin last year attempted to show that the frequency of flash crashes grew quite a bit ahead of a crash in the U.S. Treasury bond, and Pragma also noticed that one pair of forex relationships would trigger a flash crash in another pair. So there's a potential correlation between flash crashes. Okay, so in conclusion, in this research, I have drawn upon a couple of research papers on the statistical existence of flash crashes. I've expanded on those two studies by redefining and improving on the definition of what a flash crash is. It turns out that's really fundamental to beginning research on this, which appears to be a new thing. It's an expanding field of research, and the first thing that we need to do is agree on the definition of a flash crash. In further work, I would like to use the data set, which I've defined for flash crashes, stop it at the flash crash, use all of the information ahead of that, and then that way you can evaluate which of the potential predictor indicators would be actually useful for predicting a flash crash. In addition to predicting a flash crash, it might be that the statistical layouts of flash crashes themselves are themselves predictive of other things. It seems to be reasonable that a flash crash might be predictive of the overall market, the overall value of an equity going up or down, or it might be that a flash crash in one asset class would be predictive of flash crashes in other asset classes. Also, flash crashes in general are an opportunity for either arbitrage, or if you do have a good prediction of flash crashes, then you would be able to create a new type of insurance for such an event. So that was my presentation, and thank you very much.